Good afternoon. Welcome to the Tax Advantage Retirement Vehicles for Commercial Real Estate Investment webinar. On behalf of myself, Leah Chrisman, conference producer, Linda Chrisman, owner of the Mid-Atlantic Real Estate Journal, and Ronald Shapiro, producer of today's event, we would like to thank you all for joining us this morning. As you may know, the Mid-Atlantic Real Estate Journal is a commercial real estate trade, print, and digital publication. We have a readership of over 25,000 industry professionals throughout the Mid-Atlantic region. If you have an interest in learning more, please reach out to me directly. I would like to thank our sponsor for today's event. Without their generous support, this conference would not be possible. Thank you to our title sponsor, Next Generation Trust Company. I would like to introduce the moderator of today's event, Ronald Shapiro. Ron is Assistant Professor of Professional Practice in Finance and Economics Department of the Rutgers Business School. He teaches real estate finance, investments, and financial management courses on the New Brunswick campus. Prior to Rutgers Business School, Ron was Senior Vice President with Connect One Bank. If you have any questions throughout the webinar, please send them directly to Ron. Now, please welcome Ron Shapiro and his amazing expert speaker.
Thank you, Leah. Good afternoon, everyone. This afternoon, we are very pleased to present Brittany Melville, Director of Marketing and Sales for Next Generation Trust Company. As Leah mentioned, Brittany will present tax-advantaged retirement vehicles for commercial real estate investments. As Director of Marketing and Sales, Brittany directs the sales, marketing, and consumer relationship management for the firm. In her role, she develops and oversees the implementation of her marketing strategy, or I should say the firm's marketing strategy, across all media outlets, and she works with her team to support all sales initiatives. Brittany graduated cum laude with a BS in marketing and business administration from Boston College. She's certified as a self-directed IRA professional. And I would also, as well, like to thank Brittany and her firm for their sponsorship and their participation in today's event. And with that, I will hand it over to Brittany.
Thank you, Ron and Leah. Thanks for having me today. We are going to talk today about an interesting topic within the real estate space that relates to commercial real estate and retirement planning all rolled into one. So whether you are a real estate agent, an investor yourself, a financial professional or attorney, this is a topic that has had some growing interest and eyes on it in the recent years. So for anyone who might have sort of heard about self-directed IRAs or retirement accounts through word of mouth or through others, peers in your network, I'm going to dive in today and do sort of a 101 on how these work conceptually, as well as how they can be applied to real estate investing. So with that, just to clarify quickly, Next Generation's role as it relates to these types of accounts, we're not financial advisors, so we're not competing with any financial planners. We're not a brokerage house, and we're not a bank. We are actually a third-party custodian for these types of retirement accounts. So as a custodian and an administrator, our role is to hold the IRAs, to do the tax reporting, any record keeping on them as well. We also provide statements, reporting of valuation, and then we have a team that will review and process the investment transactions associated with these types of accounts as well. So just to clarify, we are not, as I said, we're not advisors, so we're not fiduciaries in any capacity. Typically, when we hear about IRAs, we think about working with an advisor, and we'll talk about what makes self-directed IRAs in a moment a little different, but just want to throw that out that we do not provide investment advice. We don't review investments for legality or endorse any specific investments or sell investment products. Our role, as I just explained a moment ago, is purely to administer these retirement accounts and fulfill our obligations to the IRS. So a quick background on the company. We are also located in New Jersey. We are a women-owned business based in Essex County, and we've been in business for almost 20 years. Our founder and CEO is still at the helm of the ship. She actually started as a real estate broker, and she also owns a property management company. So she got into this business through her passion for real estate and a desire to put some of her own investments into a retirement account. So through going through that journey and discovering how it worked, she founded her own self-directed IRA firm. So we now are a trust company as well, which gives us the ability to act as a custodian for all the clients' accounts. And we've been very active in the industry, not only in real estate, but in the alternative investment space as well. So just getting down to the actual definition of what makes a self-directed IRA, this term gets thrown around a lot, I think loosely, to have some different meanings, but for today's purposes, we're talking about a retirement account that allows you to invest in what we call non-traditional or alternative assets, so non-publicly traded assets. Typically, when we think about IRAs, we think, okay, I have to be invested in stocks, bonds, mutual funds. With self-directed IRAs, those options are extended to allow for things like real estate, private equity, and some of the things that we're going to talk about today. So the idea behind utilizing a self-directed IRA for these types of things that you might already be investing in or might already have invested in the past is, one, the tax advantages associated with using a retirement account as the investment vehicle itself. Of course, anything that's earned on investments in an IRA is coming back into that account in a tax sheltered manner. So there's a benefit there. Additionally, it's going to allow the account holder to choose their own investments rather than having to select from sort of like a platform or a menu of pre-approved investments. They can actually go out and with their expertise, they can find deals, they can seek their own property to invest in or purchase. So it gives a little bit more control to the account holders themselves, and also potentially better control over the return on investment. And also in the alternative space, this is something that can hedge against stock market volatility. So if we have all of our eggs in the stock market and we see crashes and dips like we've seen, last year, for example, and in prior years, we don't have a lot of control over those things. But with alternative assets, they tend to be non-correlated with the market. So it's a further diversification play as well, including some alternatives in a retirement account. And the idea behind that being that this can produce more stable returns over a long period of time. So when we talk about self-directed IRAs, there are also several types of IRAs that can be self-directed into real estate and other alternatives. And you may or may not be familiar with these account types. Most people are familiar with the traditional IRA, which is your run-of-the-mill regular IRA. You might have rolled over from an old 401k, and now you have this IRA in the market. Those funds are pre-tax funds that go into a traditional IRA, and then as earnings grow, those are tax-deferred earnings, so that at retirement age, when an individual decides to withdraw them, they would be taxed at that time. A Roth is sort of the flip side in that it holds after-tax dollars, and the beauty of that is once dollars in a Roth are invested, as they grow and earnings are accumulated, they can actually be withdrawn, of course, again, retirement age or qualified age. They're completely tax-free. So for example, if you had paid tax on a $10,000 and you put $10,000 in a Roth and you invested into the project and you grow it to $50,000, that $40,000 gain would never be taxed if you're withdrawing it from a Roth in a qualified withdrawal. Additionally, for business owners, and this comes into play a lot of times in the real estate space, whether you're an agent getting paid on a 1099 basis, contractor, you're an investor that owns your own business or a partnership, there are specific retirement accounts that are designed for business owners. So the SEP, simple, and then other types of qualified plans are typically designed so that they allow for larger out-of-pocket contributions on a regular or annual basis. So for example, traditional and Roth IRAs typically only allow you to put in $6,000 per year out of your own pocket, or $7,000 if you're over the age of 50. But with SEPs, you can actually contribute 25% of compensation from your business that you run, up to a max of $58,000 per year. So there's a lot of greater potential if you own your own business to utilize funds from your business to put away into a retirement account. And then the last two are not necessarily retirement accounts, but they are tax advantage savings type accounts. The education savings accounts for minors that can be used to save up money for a child's education and withdrawn tax-free for education purposes. And then the health savings account, which we're probably all familiar with, but not many people know that they can be self-directed. So rather than just holding funds in there, sort of like a savings account, you can strategically invest the dollars in an HSA to grow that. And then you could, of course, withdraw for medical expenses tax-free. So once you have a self-directed IRA, you would need to set one up separately from an IRA that you might already have or that your clients might already have. Getting funds into that to start investing, you're going to have a few options. So we mentioned a moment ago the idea that you could contribute funds out of pocket, and then you can stash those into your retirement account. The IRS sets those limits annually. If someone has an IRA with another institution like Fidelity, for example, or Morgan Stanley, they are typically not going to hold alternative investments or alternative assets like real estate, private equity, et cetera. So the option would be to take some or all of the funds from another IRA and transfer them from that trustee to the self-directed IRA. That is not a taxable event. It doesn't get reported on any tax forms, and there's no limit to how many transfers you can do. So that is a very common way for individuals to get cash into their self-directed IRAs to start investing. Alternatively, if there is an old employer plan, perhaps someone left corporate America to start their own business or get into real estate investing, and they have an old 401k or an old similarly typed plan that's no longer active, those funds can be rolled over into a self-directed IRA to work with as well. And then, of course, if someone is moving funds from one of the tax-deferred type accounts to a Roth, which is an after-tax account, that can also be done. It's called a conversion. And what would happen is in the year that movement of funds takes place into the Roth, that amount that's moved or converted would be subject to income tax that year. But then, of course, once the funds are in the Roth, from there, as we mentioned, they grow tax-free. So these are the different options for getting cash into accounts to start working with. And then we get to the more interesting part, which is what can you invest in with a self-directed IRA? So definitely real estate, as we know, we're going to talk about that today. Even within the realm of real estate, there's so much that you can do. And this is probably the lion's share of asset types that we hold as a custodian for self-directed IRAs. I would say with private equity being a close second, but even in the real estate space, there's a private equity component. So you could either purchase property directly with a self-directed IRA, invest into a private fund or a private company that's investing in real estate in a more passive way. You could purchase distressed notes or underperforming notes and then collect on those, sort of acting as the bank through your IRA. You could form partnerships with a self-directed IRA and other IRAs, or a self-directed IRA and other individuals or companies, invest in hedge funds. The other big one in real estate is private lending. So a self-directed IRA could act as a lender, either to an individual or a company, in which case the IRA is going to then collect its principal and interest or other returns back into the account. So as you can see here, there's a ton that you can do. The IRS really only clarifies what you can't do which is hold life insurance and antiques or collectibles in an IRA. So just to clarify sort of the flow of things, because I think we tend to get a lot of questions about this from people who are new to this concept, is you're saying I can invest in real estate with my IRA, but if I take money out of my IRA to buy real estate, wouldn't I have to pay a penalty or pay taxes? So if you took it out yourself, yes, you would. But how this works with a custodian as sort of the middleman in this process is the custodian sends funds out of your IRA to purchase this asset or do this investment. So you're not taking it personally, but rather you're directing the custodian as to what you want them to do and what you want them to invest in with your cash from your IRA. So the custodian will then send those funds out. And then once that yields a return, whether it's rental income, proceeds from sale, whether it's some sort of dividend or equity, it's going to come back directly into the IRA, not to the IRA holder personally. So that way it's maintaining that tax sheltered or tax advantage status. So I just wanted to make sure that that was clear in order to not trigger any penalties or taxes. That is sort of how the flow would work. So there's three ways that, especially in the real estate space, typically individuals might benefit from understanding or utilizing self-directed IRAs. So one way is not necessarily for someone to have their own, but to leverage other self-directed IRAs capital for funding or as investors. So one way might be someone needs to borrow funds for a project and somebody they know has an IRA and they're willing to use it to lend those funds. In which case, a promissory note would be drafted between the two parties. The IRA sends the money out to the borrower. The IRA would be the lender on the note. And then, of course, any principal or interest paid back to the lender, aka the IRA, goes back into its account. So if you think about that, and for example, I'm just throwing this out there, but like an interest rate of 10%, that's a 10% return on investment in an IRA that might not get in the market depending on the circumstances. Another way that someone might leverage other people's self-directed IRAs is to directly invest with them as partners or purchasing stock or investing directly into their company. So if someone's looking for investors for some deals, IRAs are a place to look. Even talking to people in your network to see if they're willing to utilize their IRAs. It could be that they are willing to invest, but they don't have sufficient cash out of pocket, but they're comfortable using some from the retirement account. So this is one way to look at it. Another way is using your own self-directed IRA to lend funds in the real estate space. And this is obviously going to be more of a passive approach to investing with a self-directed IRA. And it's sort of just the flip side of what I just described a moment ago. The IRA is the lender. In this case, you send your funds out to borrower. The borrower pays the IRA back. So similar concept. This is where it gets a little bit more involved and a little bit more, it could potentially be more of an active investment. The third approach would be using your own self-directed IRA to directly purchase property or purchase property through an LLC. So there are a few ways to do this. And sometimes we'll speak with investors who say, okay, I want to invest in real estate, but I have $50,000 in my IRA. It's not enough to buy a property, right? Or there are cases where someone might have sufficient cash in their IRA to purchase a property outright. So that's one way to do it, is to buy a property in cash. If you do not have sufficient cash in an IRA and you want to solely purchase a property in the name of the IRA, where the IRA would be the owner, another option is to get financing. However, the loan that an IRA takes in leveraging property would have to be a non-recourse loan, which essentially means that if the IRA defaults on that loan, then the lender can only foreclose on that property that's leveraged. They cannot go after other assets in the IRA or the personal assets of the account holder. So it is more of a restriction for the lender. Typically, you will see that they require more money down on those loans. They may require a cash flowing property depending on what they're comfortable with. So if someone is interested in that approach, we typically suggest that they reach out to some non-recourse lenders to understand the terms and criteria. And there are some lenders that we're aware of that clients have used. They're typically banks that would offer these types of non-recourse loans. Another option, if someone doesn't have enough to buy in cash or doesn't want to do the financing route, is to partner the IRA with another individual or multiple partners, so that the IRA takes a portion of ownership of the property and then the others would co-own it along with them, which is common in the industry anyway, and a way to get the IRA into an investment without requiring, for example, 6 figures or a ton of cash. So that's another way that it could work. And of course, it could be a fix and flip deal or buy and hold. Or it could be purchasing raw land to develop on that land. So that's an option. And partnering is obviously a way to not have to deal with the non-recourse financing and then utilize funds from multiple streams to pool together and make a purchase. As I had mentioned, this can either be done directly in the name of the IRA or the IRAs, for example, where the property would be titled and deeded to the name of the IRA, or this can be done through an LLC, where a newly formed LLC is created, and then the IRA would invest into that LLC as a member, in which case the account holder could be listed as a manager of that LLC, set up the business checking account for that LLC, which would essentially contain the retirement account funds, and then have some access to the checking account to be able to pay for things, could open a debit card, could write checks associated with the investment, and then that would work through the LLC and the property be titled to the LLC itself. So there are a lot of great things that you can do with self-directed IRAs, but the IRS does also have some rules. They do not allow what they call prohibited transactions, and it's essentially any transaction between the IRA and what they deem to be a disqualified person. So I'm going to skip ahead real quick and define that. They have provided this list of disqualified persons, which again are not permitted to transact directly with the IRA itself. So that would be the IRA holder personally, any spouse, ascendants, descendants, or their spouses. So if you think of the family tree in like a lineal direction, those relationships are considered disqualified from directly transacting with the IRA. However, non-lineal relationships with family like siblings, cousins, aunts, uncles are okay. I can't say why that is or why the IRS decided that, but they allow those relationships. And of course, anyone who is not related to you, who could be like a friend or just somebody that you know in your network, free to invest with you in your IRA. The other restrictions would be on any companies providing a service to that IRA. So, or any individuals providing a service like an attorney, a financial advisor, a financial planner, a CPA or tax advisor, or any company that is 50% or more owned by a combination of these disqualified persons would not be allowed to directly transact. For example, if an IRA wanted to invest in, someone had a self-directed IRA, wanted to invest in their family's family-owned business, and it was 50% or more owned by their parents. That would not be allowed by the IRS because the parents are considered disqualified persons, and if they had majority ownership of this company, the IRA would not be allowed to invest in it due to that relationship. So I actually just explained the first type of prohibited transaction, which is just here a direct transaction, purchasing something, selling something, lending or borrowing from or to any disqualified people, not allowed. Same thing with extending credit. So I had mentioned lending, but also if an IRA is taking a loan, the owner can't personally guarantee that loan, nor could a disqualified person guarantee the loan, provide any credit. And then the self-dealing prohibited transaction, which tends to be a little bit more sort of gray area, usually comes into play where someone is benefiting from the IRA's investment, maybe not a direct financial benefit, but it is somehow a conflict of interest. An example of that might be that, let's say the IRA holder purchases stock in a company, and because of that stock purchase, now an opportunity is opened up to the IRA holder to purchase a different series of stock. So it's only for the reason that their IRA made an investment, now they have access to this new opportunity. That would technically be considered prohibited because it's only through the IRA's investment that they were able to do that. So it's sort of like a double benefit, if that makes sense. Typically this can, when we get into situations that are a little bit more complex, it comes down to understanding the rules, and usually the custodian, such as a Next Generation, for example, would be involved in making a determination as to whether this could be held in an IRA. So these are just things, though, that are important to understand conceptually, so that if someone's thinking about doing this, they're getting into it knowing what the some of the boundaries would be. So in the commercial space, a lot of times we'll see investors going in on syndications. Again, that's another way to do something passively with the self-directed IRA and may not require a lot in funding up front, so it is pretty common. Examples of prohibited transactions in this case would be, excuse me, if someone's using their IRA, they can't be an active partner, director, or managing member of that fund or that company. The self-directed IRA can only invest as a limited partner. And then, of course, anything paid back from an earnings perspective does not go back to the IRA holder. It goes first to the IRA itself. And then if the IRA holder wanted to withdraw those funds or move them, of course, they have the right to do that, but not until the investment is liquidated and the funds first go back into the IRA. Another rule when IRAs are involved, and this usually isn't an issue with commercial real estate, but no sweat equity is allowed by any disqualified person. So if you invested in a property, for example, and then it needed repairs, you wouldn't be able to physically do that yourself. You would have to either utilize a property management company or contractors or any non-disqualified person to do those repairs. Some other real estate guidelines that are important to be aware of is, of course, if the self-directed IRA is going in on a purchase and funding the deal, then any maintenance expenses, repairs have to come out of the IRA, just as it's entitled to any investment returns as well. If it's 100% owned by the IRA, then the IRA is responsible for 100% of maintenance, expenses, repairs, et cetera. And usually that's done by the investors planning ahead sort of what they expect to need and making sure they have enough cash buffer in their IRA to handle unforeseen expenses. Of course, if it's a rental and there's rental income coming back into the IRA in the form of cash, then that's going to also build up your reserves. But another option, if additional funds were needed, would be to get a loan or take a loan, make a contribution to the IRA. So there are different other options to get cash in if additional cash is needed. We talked about the sweat equity restriction. Another example of prohibited transactions would be having disqualified persons living in the property or renting or using the property that's owned by the self-directed IRA. And then, of course, another important thing to note, and a lot of times this comes up too late after the fact, is that any paperwork signed on a deal, including initial deposits, if the IRA is going to be making the purchase, have to come out of the IRA. So a lot of times we'll have investors come to us and say, I signed an offer and I put down a deposit on this property and now I want to move it into my IRA. Unfortunately, if that's the case and they've done it personally already, then it's too late, because moving it from their personal name into their IRA would be a prohibited transaction. So getting this type of education proactively and ahead of looking at deals like this is very helpful for everybody involved, because it'll just ensure a much smoother, streamlined experience when it comes to setting things up and doing them appropriately. So if this is something that somebody wanted to pursue, typically the process would look like, it's going to take several weeks at minimum, but it starts with establishing the self-directed IRA as a new account. So that requires just filling out an application, and then that can be open within 1 to 2 business days. Funding the account through one of the methods that we talked about, which is either making a contribution, transferring from another IRA, rolling over from an old account, or doing a conversion from a non-Roth to a Roth account. So any of those things can be done. That's going to be done with the help of the self-directed IRA custodian, working with the investor to fill out some paperwork and then contacting their old institution to request the funds be moved into the new account. As you can imagine, the timeline for that varies very widely. It could be as quick as a few days. It could take a week or two. It's going to depend on the other institution's willingness to process those things in a timely manner, and whether they have any specific requirements that have to be met in order for them to release the funds. And then thirdly, making an investment through the self-directed IRA is going to require the account holder to submit some documentation to the custodian. That's going to be a combination of supporting documents for the investment. So for example, if it's real estate purchase, if it's a direct purchase, it would be the purchase contract, the agreement, eventually the deed, a copy of the deed once recorded. If it's going to be more like a private equity investment, then we would want to see a subscription agreement if applicable, or a partnership agreement, whatever the IRA is going to be investing into and what the investor would normally sign. We would review for accuracy to see that the IRA is listed appropriately there and we don't see any blatant prohibited transactions taking place based on the terms. And then the custodian actually signs those documents, not the investor themselves, on behalf of the IRA. If it's a note and we're talking about private lending, then we would want to see a copy of the note. As far as interest rates are concerned, we're not dictating those, but we do look to see that the interest rate is fair and reasonable, within market rates, and that the terms seem fair and reasonable. And then in addition to supporting documentation, that there's some internal documentation the custodian will require that the account holder submits to them. So a direction of investment, for example, if they're directing the custodian to make ABC investment, we would be asking them, what are you investing in? How much? When? Who is involved? That if we need to be in contact with anybody associated with the investment, how do you want the funds to be sent out of your account, and where do you want the funds to be sent? So we're essentially sort of executing these orders from the IRA holder because we're not advising, but we're doing our due diligence in terms of it being administratively feasible, and then reviewing everything for accuracy so that we can properly document things for tax purposes. So with that, upon receiving that documentation from the account holder and or investment sponsors, there's a 2 to 5 day administrative review that's done, and then the investment, assuming all looks good, we'll go ahead and process it. And then of course, any subsequent payments that need to be made out of the IRA could be authorized through the custodian. Same thing with any payments coming in are sent directly to the custodian to be deposited into the IRA. So all in all, we typically would tell somebody that's new to this entire process, and if they don't have an account already established, to be safe, give it 4 to 6 weeks to get everything set up. So we understand that real estate deals move quickly. So usually what we suggest is if someone even is just getting ready to do a deal and they want to do it in their IRA, that they should at least get started establishing their account, getting the paperwork together so that when they find that deal, things are set up and can move relatively quickly from there. So essentially, the idea behind this education, it might mean different things to different individuals in this space and in this industry, but having the understanding that whether it has value to you personally or not, there are lots of individuals out there utilizing IRAs to invest in real estate. There is a whole community of people out there, and there's $19 trillion tied up in retirement accounts. So there's a lot of money out there that can be used and leveraged into some deals. And if you are working with or representing investors using IRAs, then having an understanding of this process is helpful. If you are providing advice or guidance to clients of yours in a space that want to invest in these types of alternative assets, then just having a general framework understanding of this could be helpful, or at least being able to point them in the direction of a resource that can then help them answer additional questions or get things set up. There's a lot of value in just having the education. So regardless of how you decide to use it, I hope that this was valuable. And I think from a timing perspective, we're almost at 40 minutes, Ron. So we could take some questions if there are any.
Okay, well, thank you, Brittany, for an excellent primer on this topic that obviously I think is foreign to a lot of people. Let me throw out the first question, which I normally like to do. So assume that you have a commercial real estate property that's already in the IRA and the custodian is handling it. What happens 2 or 3 years later down the road if there are leasing issues, or if there are renovation issues or capital improvements need to be made? How does those future activities work? Does the custodian have sole responsibility for that, or does the particular client or owner of that property still able to get involved?
That's a good question. So the client, in this case, the IRA holder, is still going to have the choice to, for example, if there are leasing issues and they need to be, some tenants need to be evicted or new tenants need to be brought in and screened, that is all still for the account holder to do. So the custodian's not going to do any of that. Same thing if improvements need to be made, and as long as the funds are in the account holder still has the freedom to decide, how they're going to strategize that being done, what contractors they might want to hire. So they can still go to the property as well physically, even though I had said no sweat equity, they can still physically go to the property, go inside the property, oversee it. They can still sort of manage it from a non-tangible point of view. So I'm glad you asked that, because I hope that it wasn't misinterpreted to mean that like they didn't have any decision-making power. They certainly still do. The custodian is only going to be executing things from a financial perspective in terms of moving funds as needed. Does that help?
Yeah, so the account holder is able to continue an active management process or philosophy. The management doesn't get taken away from the client and moves to the custodian.
That's correct. Yeah.
Okay. All right. Let's see if there's any questions from our audience. And I'm not seeing anything in the chat. So nothing's coming up. Let's give it a couple minutes. And while we're waiting, what about negotiating the price, Brittany, of the real estate? That's strictly at the hands of the account holder, I'm assuming.
Yes, same. Yep.
Okay.
Same would apply. Negotiating the price, any offers that are put in, all of that. The custodian would just simply need to know what price is agreed upon. So when the contract is signed, the timing of payments, closing date, that would all be very important for the custodian to know, just so that we're working to the timeline to make sure those funds are going to be available, and how those funds need to be sent out as well.
All right, we do have our first question. let me see if I can read this. Beth is asking, seems that I would have to use a note because I have to go recourse. Can you get into that discussion a little deeper?
So if the question is asking if recourse is needed, I'm sort of jumping to an assumption about exactly what the question is asking. So let me go into a little bit more detail maybe on the non-recourse requirement. Hopefully that will help. So if an IRA needs if an IRA needs funding and the IRA wants to take a loan itself, or the IRA is the borrower, the only way that the IRA can do that is through that non-recourse loan. So basically, this is saying that if the IRA needs a loan in connection with a property that's going to be purchased, whether it is for additional repairs or whatever it might be, the IRA holder can't personally guarantee it. The lender essentially has to be okay with saying, if you don't pay me back, I'm just going to foreclose on this property and take the property, but I'm not going to be able to take anything else from you, the holder of the IRA. Or if the IRA has other investments that it holds, that lender wouldn't be able to seize any of those assets or anything like that. So it's designed essentially to protect the IRA. I'm sorry. So it's essentially designed to protect the IRA and the IRA holder as well from that sort of liability.
All right. Brittany, we have a clarification from Beth, and she's now saying, no, I'm buying a $3.2 million property and need the IRA for the down payment. I have a 80% recourse loan. Can this be done or not?
Okay, thank you for clarifying. If you're just looking for the IRA to make the down payment, unfortunately, that wouldn't be an option. So if the IRA is going to contribute anything to the investment itself, then it needs to be all in part of the deal. So the IRA is going to contribute a portion of down payment, then it's also going to contribute a portion of ownership. And it would also depend on who else is involved in the deal as well. If the IRA is going to be making a down payment and the IRA is going to be the only owner of the property, and if the IRA can get that type of non-recourse loan, then that's fine. But if someone is looking to purchase a property and then they just want to use an IRA for the down payment, but then buy it in their name, that wouldn't necessarily be something that would be allowed by the IRS. Hopefully that helps.
I would say most people view real estate as more of a complicated type of asset, and I assume that they would have a financial advisor or a tax consultant working with them. Are these people that you generally work with respect to your custodial activities?
That's a good question as well. We typically encourage investors to have those individuals in their network to utilize those resources. So since we do not in-house provide tax, legal services, or financial advice, there are other individuals that should be leveraged, or there are other individuals that should be able to help with those and should have an understanding of self-directed IRAs. So for example, when we start getting into legal questions with IRAs, ERISA attorneys are the resource to utilize and lean on for guidance in that space. So ERISA attorney is going to be familiar with ERISA guidelines. There are ERISA attorneys that our clients have used with their self-directed IRAs for opinions on different things, or if anything comes up throughout the course of having self-directed IRA and an attorney's opinion or attorney's guidance is needed. While we don't necessarily have any of those individuals on staff, and we don't necessarily endorse those other individuals, we're happy to provide that contact information for those attorneys, CPAs, et cetera, that other clients have utilized. And then, those contacts can be spoken with directly, if that's helpful.
All right, checking the chat. Here's another question from Anonymous, which I guess is okay. Can you clarify what ERISA means? Okay, that's a defined term, but go ahead.
ERISA is the Employee Retirement Income Security Act. So it basically it basically defines how retirement accounts are handled, and some of the laws and provisions surrounding them are very specific. So there are lots of attorneys out there, but not every attorney may have a specialization in ERISA. So that's where it comes into play, because we're talking about utilizing retirement accounts in this case.
Brittany, when a property is ready to be sold, 5 years, 10 years, 15 years later, again, what role does the custodian have with respect to the whole sales process, or is it literally moved over to the client and the client has to deal with the entire sale process?
So again, the client's going to negotiate sale price and the terms of sale and that sort of thing. And again, we're going to want to see the contract. Anytime funds need to be dispersed or funds are being sent in association with the sale, those should be paid to the IRA. So it's important for the custodian to be aware of and notified that property is going to be sold, but again, the custodian's not making decisions or determination with respect to price or terms or timeline or that sort of thing. It's just the most important thing is making sure that any funds associated with that liquidation of that property or liquidation of the investment are going back into the account holder's account and not to them personally. So any payments would need to go to next generation for the benefit of client's name, IRA.
Okay, well, there are no more questions that are popping up. I have no further questions. So let me, first of all, thank the audience for joining in this afternoon. I also want to thank Brittany for an excellent presentation on, again, a topic that, quite frankly, is new to a lot of people. I would also ask the audience listening in that if they have any thoughts for future topics, feel free to email them to me or to the Mid-Atlantic Real Estate Journal. Love to get any feedback on ideas that you may have. And I must also ask that if any listening members would like to become Brittany Melville in the future, obviously, feel free to reach out to me or you. And I guess while I'm providing those finishing comments, I think there is one finishing. No, that's okay. That was Brittany emailing the panelists, everything. Okay, so Brittany, any last comments you have?
I just wanted to your point about the chat, what I just put into the chat.
Sure.
Here, first of all, here you should be able to see some contact information. So I know we had a limited time to cover this today, and there's so much on this topic. We can talk for days about this. So if anyone would like to get into any of these things a little bit deeper, or just have specific questions that you didn't get to throw out today, feel free to reach out directly. My email address is here, my individual email address, as well as my team's email for any new accounts or new account inquiries. So anyone on my team can answer questions. We're also on all social media, and obviously we have our phone number here as well. A lot of us are remote, but we do have someone in the office answering the phones. If you need to reach any of us directly, it can be done that way. And then I did drop into the chat a link to access any subscriptions to more information, or just get into more information if there's something that you wanted to check out. Tons of educational resources on the website, webinars, white papers, the blog. There's also a link in there. If you click that link, there is an option to also schedule a complimentary educational session. Anybody can use that link if you wanted to share it with someone who you think might benefit. So feel free to reach out if you'd like to learn more. And thanks everyone for your time. I appreciate it.
Okay. Thank you very much, Brittany. I want to thank again Next Generation for their participation and sponsorship. Obviously, I definitely want to thank the Mid-Atlantic Real Estate Journal for putting this all together. And as Brittany indicated, if anyone has any further questions, you can certainly direct your attentions directly to Brittany herself. She's more than happy to respond. With that, our program has concluded. Thank you very much, everybody. Have a nice day.
Thank you
Bye-bye.
guys for the opportunity. Have a great day.
Bye-bye.
Bye-bye. Oh, we still on?